What penalties does the CRA impose for unregistered foreign sellers? Foreign businesses entering the Canadian market often underestimate the seriousness of GST, HST non-compliance. The Canada Revenue Agency, CRA, expects non-resident companies making taxable supplies in Canada to register for GST, HST promptly. Failing to do so does not excuse the business from its tax obligations, and the CRA may impose penalties, interest, retroactive assessments, and compliance audits to recover unpaid taxes. For U.S. companies selling goods, digital services, subscriptions, or consulting to Canadian customers, understanding these consequences is essential for avoiding financial risk and disruptions. Failure to register does not remove tax liability. Many non-resident businesses assume that if they are not registered, they cannot be taxed. In reality, if registration was required, the CRA can assess tax retroactively from the date the business should have registered. That means the business may owe GST, HST on all taxable Canadian sales during that period, even if it never collected tax from customers. This creates a dangerous scenario where the business must pay the tax out of pocket. CRA penalties for late registration and non-compliance. Once the CRA determines that a foreign business should have been registered, penalties and interest begin to accumulate. The CRA also has broad authority to enforce compliance regardless of whether the business operates physically in Canada. Here are the primary penalties unregistered foreign sellers may face. Failure to file penalties when returns are not submitted for prior periods. Failure to remit penalties when collected tax was not sent to the CRA. Interest charges on amounts owing backdated to the original due date. Assessments for uncollected GST, HST requiring payment even if tax was never charged. Additional penalties for gross negligence or repeated non-compliance. These penalties can accumulate quickly, particularly for high-volume e-commerce or SaaS providers. Retroactive assessments can be significant. If a foreign business made taxable supplies without registering, the CRA can assess GST, HST for all previous periods in which registration was required. Businesses selling digital services or storing inventory in Canada often discover years later that they should have been registered earlier. Retroactive assessments include GST, HST owing on all prior taxable sales, interest on the unpaid amounts. Applicable penalties. Because the CRA can review multiple years of activity, assessments may impact cash flow substantially. Marketplace sellers are not exempt. Some foreign sellers believe platforms like Amazon, Walmart, or Etsy fully manage tax compliance. While marketplace facilitator rules apply in certain provinces, federal GST, HST remains the responsibility of the seller in many cases. Failing to register because of platform misunderstandings is still considered non-compliance. The CRA assesses foreign sellers even when sales occur through a marketplace. Gross negligence penalties. When the CRA determines that a business intentionally ignored registration requirements or failed to comply despite knowing the rules, gross negligence penalties may apply. These penalties can be up to 50% of the tax owing, significantly increasing the financial risk. While rare, these penalties are more likely for businesses with repeated non-compliance or those who ignored warnings. A practical example. A US seller uses Amazon FBA Canada but never registers for GST, HST because they assume Amazon handles tax. After a CRA audit, the business is assessed tax for 2 years of sales plus interest and penalties. Because the business never collected GST, HST from customers, the entire amount must be paid from company funds. In another scenario, a SaaS provider serving Canadian clients without registration is assessed GST, HST retroactively based on subscription revenue. Although the business has no physical presence in Canada, the CRA still enforces compliance because digital services are taxable supplies. Final thoughts. CRA penalties for unregistered foreign sellers can be substantial. Failing to register does not eliminate tax obligations, it only increases the financial consequences. US businesses must evaluate their Canadian activity carefully to determine when registration is required. Proactive compliance prevents penalties, interest, and unexpected retroactive assessments. If you'd like more insights delivered in the same straightforward style, you can explore our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.